And welcome to the latest episode of Hung Chin Hon Sweatin Money, recorded on March 14th, 2016. We may or may not have ownership or other positions in the stocks mentioned on the show. Don't buy stocks based solely off what you hear from this podcast, and always do your own homework and research before investing in stocks. I'm your host, Kong, along with my co-host, Gibson. And let's take a look at what's in the news. Bloomberg goes into the history of how exchange-traded funds came to be, starting with an SEC report on how things traded in baskets could have lessened the volatility during the recession of the 1980s. So, CalPERS, the retirement system for California state, county, and municipal employees, has successfully sued the ratings agency Moody's for $130 million for loss of investment money. Some people may say it's their own damn fault because they're dumb enough to invest in these poor quality, equities and bonds. But Moody's also misrepresented a lot of equities and bonds with inflated ratings. So, can this ruling help individual investors who've fallen into the same trap?
I hope so. I'm not sure if I've been affected by it, but I think I'm due some money. Maybe $100 million or something.
Well, I'm
just joking.
Think about it, man. The state of California spent all this money on, lawyers. Well, they probably already used some people from, the state attorney general's office to go after these guys. So I guess they're already on state payroll. But still, you're wasting a lot of time, and a lot of this money is going to probably compensate for other things. It's probably not going to go back into the entire CalPERS system. So I really don't know what's really been accomplished here.
I don't know. I think it kind of established the possibility that we can rely on Moody's ratings to determine profitability of things, which I think is kind of weird that they can actually sue them for that. I mean, they misrepresented it, but sure. Who told you to trust Moody's ratings in the first place?
Well, aside from the fact that they're world class, they were one of the three ratings companies for this sort of stuff. So, it's kind of hard not to trust them.
Well, the only thing you can really trust is supposedly any type of SEC report that's been audited by the big fours of the accounting firms, and that if they account by the GAAP standard, that's really the only thing you can really trust on the market. And if you can't trust that, you pretty much can't trust anything.
All right. Well, on the flip side, Hong Kong's outlook was downgraded by Moody's recently, mainly thanks to the PRC's meddling with Hong Kong's internal affairs, to borrow one of their much-used phrases, because of the PRC's interference with Hong Kong's education, human inflow policies, developmental policies. Hong Kong has lost its own independence, and its financial standing with the rest of the world is at risk. This is evidenced by the fact that HSBC declined to move its headquarters from London to Hong Kong, despite the fact that it actually makes most of its money in the East Asian region. Now, not just that, but in the Chinese media, the finance secretary Zhang Zhenhua said that Moody's has misinterpreted the 中国风险, or Chinese danger, and that it should be an opportunity. Yeah, opportunity to allow more mainland Chinese, smugglers, polluters, let's see, and, who needs sanitation? People crapping on the floors and pissing all over the place in public spaces. Never mind that there are public restrooms all over Hong Kong. Sanitation, so overrated, right?
Totally.
Now, keep in mind, this is Moody's outlook on Hong Kong, and it is different from Hong Kong's credit rating, which still remains strong, unlike mainland China's, which they downgraded on March 2nd.
Uh-oh.
Yeah. Now, Thursday really angered me because the head of the European Central Bank came out and said that Mario Draghi would come out with with quantitative easing, and the markets, they all cheered. Then he said that something to the effect of, this is it, and after this, no more. And that's when things started to go in reverse. That was not a good day for me.
Yeah, I don't think this year is a good year for anyone. I mean, we flip-flop way too much this year. Way too much.
Yeah. Now, China's state-owned enterprises are coming out with a move where they are paying back debt not in cash but in shares in their own stock. While valued higher, some are saying that these are mere cosmetics and don't address the real issue at hand with these companies, and that is the fact that they may not necessarily be profitable as they were before. According to the Gallup polls, consumer spending was up in Friday higher than January and way higher than it was averaging in 2009 to 2012. If this keeps going up, it's a good indicator that we won't be in a recession. However, the National Federation of Independent Businesses, a coalition of small businesses, say that confidence in profits are actually waning, and hiring rates were slower last month. Then, of course, weekly job loss numbers were much lower than expected, 2 for 1, in favor of the U.S. economy not going into a recession. Despite this, however, Bloomberg's Consumer Comfort Index was actually lower from the week prior, but despite this also says that we're not headed for a recession, but definitely not in for a bull either. So, and China's industrial production report also saw slowdowns, while we were getting news of the U.S. economy doing not so bad and not going into recession. It doesn't mean that demand for Chinese goods is up, especially when considering Europe's still volatile position. However, this doesn't mean China's economy is headed for an economic downturn, not yet at least. Consumer spending was actually up over there. So,
well, it depends because economic downturns are determined by overall gross domestic products. So, if we were to determine if it's on a downturn or expansion, then we will have to look at the overall GDP. But like I said, from all your articles, very flip-floppy year.
Yeah, that's true.
All the news is positive and negative at the same time.
Yeah. Well, let's take a look at the week in review. So the week kept dawdling wrong. Jesus Christ, my English. English. Like I said, Thursday was a bad day. Things dipped. Friday, however, made up for lost times. I mean, it was really good. Finally, things are starting to go my way Friday. So let's take a look at today's performance. Today we, because we're releasing this late, we were going to do this, but usually when we release this on Sunday, we're just, we're not going to do the 2 days performance, and we're just going to go straight to the international markets. But you guys are in luck. So, of course, the Dow Jones was up over 15 points. The Nasdaq, or the S&P was down 2.5 points, and the Nasdaq was slightly up 1.8. So, looking at the international markets, the Nikkei, as of the time that we started to record this, it was slightly down. So, there's that. The Shanghai Stock Exchange was also down by about 1%. Taiwan Stock Exchange was about negative 1.7%. And Hong Kong was down almost 1%. So let's go ahead and take a look at the playbook. Okay, again, just a reminder, none of the following should be misconstrued as financial advice or investment advice. This is merely provided for documentation only. So my stuff pretty much still remains. I haven't made any new bets. Basically, I got my Yelp. It's going to expire. Gold, I'm still, even though I'm technically in the money, I haven't gained anything because of the fees that are involved. And same thing with PHG. So, what about you, Gibson? How are your?
Today I couldn't. I've been absolutely adamant about avoiding the market. I've gotten into massive debates with my father regarding it. See, the thing is, he has a very traditional, he has a very typical financial advisor type advice for how to participate in the market. You basically buy when things are going well. So basically you buy towards the top. You also buy when things are going low because it's on a discount or sale. And, you know, a lot of people say, well, you want to buy when everyone's panicking you want to buy when it's most dangerous. And I don't necessarily agree with that. I think you should buy when you believe that a stock is undervalued. Stocks can be undervalued for many reasons. But one of the reasons why I don't really like the market right now is just because it's so volatile. You can't, you don't know where things are going up or things are going down. There's just way too much flip-flopping. And I'm trying to get into the market to invest and make money. I'm not, if I want to gamble, I'll just go to a casino, really. I have probably better odds, in this market. At least have a 49% chance. Or, on certain games, at least have a 49% chance. Or play some poker. So, but at the same time is that, this weekend, last week, it seemed like pretty good news. We had some positive news coming from the Feds in the sense that they were thinking about increasing interest rates. The Euro Union was thinking about stimulating the economy. And everything seemed to be calming down. Oil prices, there was talks about how they're going to establish a floor. And I'm like, okay, they're going to collude and control the prices, which will push the stock prices back up. Then, so I was thinking, I can resist it. I'm like, I'm going to make a very small wager and invest into the market. And then today, they're like, oh, by the way, the oil agreement thing is not going to pan out. And then I think Europe was like, oh, we might not stimulate the economy as much as we hope to do. And then, and then Asia's all watching America because they're looking at the Fed's decision this coming month. I think, is it this month?
Tomorrow,
yeah. They're looking to that decision tomorrow. There's a lot of uncertainty about that. And then, so basically lost a little bit of money today, but hopefully things will pan out better,
I mean, you care to tell us what your positions are? Or?
Oh, yeah. I bought a little bit of Bank of America. Just because I feel like it's a very staple, at least in the Dow stocks. And I feel like in this very uncertain market, there are a few companies that are still going to be very solid. My father's a big fan of McDonald's. I'm a big fan of Bank of America just because if the Feds do hike the interest rate, who's going to benefit? Bank of America. If the economy does do well, a strong economy may be positive and negative for the stock market. It's because a stronger economy would mean that the GDP is going up, is rising faster than the Feds really want, or could imply that it's rising faster than the Feds really want. And because of that, the Feds might reduce or increase interest rates to slow the economy down. And we've seen that with the rate hikes, the stock markets don't react well to it. But when there is a rate hike, who benefits? Bank of America.
No, the last rate hike, actually, the stocks did benefit. The one in December.
I think leading up to it has been very negative.
I mean, yeah, leading up to it, but then like when it actually happened, it actually came back up. So that's one of the things with my position in gold. Yeah, so the position in gold, usually whenever the Fed hikes come along, gold starts to drop, and I have a put position. So when that happens, I'm hopefully going to gain some money, but we're going to see. The last time it happened, the rate hike was small enough that it only dropped like maybe, I think gold only dropped like 1%. So it's still not enough for me to make any profit. So
like a rate hike might be signs that the economy is strong. It's more stable.
Right, yeah.
So because it's more stable, people don't have to worry about things being volatile, and then they move away from gold.
Yeah.
Gold has always been like a kind of a panic type of buy where I don't know what else to invest in. I'll just put it in gold.
Yeah. Now, back to the thing that you were mentioning about some people saying how you should invest during times of volatility. As far as I understand it, most of the people that usually say that, I mean, they have different sorts of accounts than what I have. I mean, maybe something similar to what you have. Like you could possibly do the same thing that they do, but they have specific strategies on the way they trade. So, well, at least when it comes to options, right? So for me and you, generally, we're just like buying puts and puts and calls. But then usually there's a mixture of like buying puts and calls, also writing puts and calls, and then, coming out with things like Iron Condors, Jade Lizard, other things like that, just to kind of lessen the amount of damage that's usually made. And usually there's a system in place. But unfortunately, for small timers like me who I may not necessarily have like the minimum amount to do that sort of stuff, which I mean requires, depending on who your broker is, I mean, some usually require you to have at least $25,000 in your account. Otherwise, certain strategies that you may want to implement, like say if you want to like buy at the beginning of the day and then sell it at the end of the day, you can't do it because if you have less than $25,000, well, I mean, maybe you could do it like for 5 times or less in a week, but beyond that, you're going to be considered a day trader, and then basically you'd be breaking some rules.
No. If you're a day trader, then you're subject to certain requirements, like a minimum balance account. You have to maintain, must maintain a margin account. Must have a certain amount of capital, and so on, so on.
Yeah. So.
Yeah.
So there you go.
But I do think that options in a way is in a certain sense, option can be a loss limiter in a sense that you can only lose the premium of your option.
Right.
At the same time, it can expose you to more loss in a sense that you would not have bought as many stocks as you would have normally done if you didn't have options. Options give you a lot of leverage.
Right.
So the best way to use option might be to limit loss on a highly volatile stock and basically to buy the option equivalent of what you would normally have spent for the stock. So if you would have normally bought like 1,000 stocks in total, you probably should just buy 10 options or just one, or like 100 stocks, just that equivalent, and you might benefit more from the loss limiting aspect of it. Now, at the same time, options can be very profitable because you give you more leverage. Basically, you normally have the capital to buy like 100 stocks, but with option, you could probably buy like 200 or 1,000 of the same stock and benefit from the movement of the stock. So you could benefit from the profits, which is like upward movement, but at the same time, you will intake that loss if it goes downwards. So you're exposing yourself to tenfold the loss you would have done if you didn't use options. But I think what's interesting about options is basically, it gives you options. So a lot of different ways to make money on the market. So like a buy and a put at the same time, which is like the iron condor, or like you could do a straddle, or there's other techniques available that basically you make your money if the market moves enough in an upward or downward direction. So your focus is more on the spread, which might be easier. You bet instead of, it basically gives you additional betting option, kind of like odds or laying odds on in the craps table. Gives you a little more options on how to win. So you basically, your bet is no longer it's going to go up or down. You're basically betting that it's going to move in an upward or downward direction. And then the other way of making money with options is basically you could sell options as well. So you could basically, play house, be a dealer and see how that goes. So very interesting thing to do. I think everyone should get their head around options. But I mean,
I wouldn't say everyone should. I mean, like you should be investing with the strategies that you're most familiar with or most comfortable with, I should say. Because I mean, options, when you're doing options, in certain ways you can make more money, but at the same time you could also lose more money too. So I mean, if you're not ready for that,
I'm not saying to invest in options, but to know how options give you more options on how to work with the market. Because then, if you only know how to do long calls in this market, like you cannot make money in this market. Right. You only knew how to do long calls when the economy went into recession, when we hit the housing bubble crisis, like you wouldn't have made any money. But you had to learn how to do puts or shorts, and not only that, but in a way, I think options might be better for shorts because you don't have to incur the interest. Yeah. That you normally have to. Basically, when you do a short, you're borrowing the stock, and then you have an interest that you have to pay on it and then basically, if you hold it long enough, you have to pay a certain type of interest and so on. But options, you kind of step away from that.
Yeah. All right. So let's move along to the week ahead. So some of the things that we're going to be looking at is, of course, tomorrow we have the Federal Reserve meeting that starts at Tuesday, March 15th. Retail sales numbers will also be out on that day. Wednesday, March 16th, the Consumer Price Index will be released, along with the EIA Petroleum Status Report and the Federal Reserve forecast, where the press conference will be held. Thursday, March 17th, we'll take a look at the weekly unemployment claims, and Bloomberg's Consumer Comfort Index for the week will be updated. Let's take a look at what to expect this week for international markets. So the Bank of Japan will make it, actually it should have made an announcement on Monday And sadly, I didn't get an article for that. I'll have to catch that up for you guys next week. But China's production and import price indexes will be updated, and also China's monetary policy assessment will be updated on Thursday. So, recommendations. So if you're thinking about U.S. stocks, being too expensive, you may want to take a look at topforeignstocks.com. They have a list of foreign stocks you can buy either over the counter or ones that are actually traded in U.S. stock exchanges. And I mean, honestly, a lot of U.S. stocks are really just expensive. So this might be a good time to jump on maybe some of the stocks in, say, India. China, we're not really sure about those guys right now.
I'm personally a big fan of United States stocks just because there are reasons why they're more expensive. If you look into the requirements to be listed on NASDAQ and NYSE, they're quite robust. And a lot of the companies that are listed there, they basically get audited by big accounting firms, and they have to abide by GAAP, and there's SEC. One of the reasons why I don't really like foreign stocks too much just is because they don't have all those regulations, and I'm a little bit paranoid that they just might fake the numbers on their financial statements. Before,
that's possible.
Yeah. Before we had Enron and Sarbanes-Oxley Act and SEC, basically companies could just say they made however much money they want. Possibly a lot of Ponzi schemes and whatnot. So there are benefits. There's pros and cons of both approaches, or both type of approaches.
Alright, so we may or may not have ownership or other positions on the stocks mentioned on the show. Don't buy stocks based solely for what you hear from this podcast, and always do your own homework and research before investing in stocks. Alright, see you guys later.